Good morning, everybody. Welcome to this week's episode of DoubleLine Minutes. I'm Eric Dhall here with Ryan Kimmel.
Yo, yo.
It is shortly after 10 a.m. Pacific here, Friday, September 19th, 2025. And it's been another week of all-time highs in equity markets. So let's kind of just jump right into the tail of the ticker tape for the week. Looking across the markets, like I just mentioned, equities reaching new all-time highs. The S&P 500 was up about 1.1% on the week, led by the technology sector up 2.6% on the week. Second place goes to the communication services sector, up 1.4%, and we'll round out the podium with consumer discretionaries up 1.15% on the week. So pretty strong performance there. A lot of that consumer discretionary, you got Amazon, you got Tesla in there. So those names could be driving some of that performance in the sector. The laggards for the week, utilities down about 1%, followed by materials down about 90 basis points and real estate down about 75 basis points. When we kind of look at some of these specialized indices, what we see is the Russell 1000 growth was up 1.6%, while the Russell 1000 value was only up 0.5%. So growth definitely outperforming value this week. Small capitalization stocks, the Russell 2000 up 2.5%, so participating in the rally. Equal weight indices, on the other hand, the S&P equal weight index only up a paltry 10 basis points. So definitely a market that rewarded mega cap stocks and some small cap stocks, but definitely growth stocks outperforming value stocks. Shifting to the fixed income markets, we saw the interest rate curve in the United States sell off this week, especially at the back end of the curve. 30-year was out 7 basis points, 10-year was out 6, 2-year was up about 2 basis points. So the curve steepened a little bit. Looking at the 2s, 10s, went from 50 last Friday to 55 currently. And the 3-month 10-year went from 3 last Friday to 15 currently. So definitely a bit of a steepener going on. And, duration sensitive securities are suffering in price. The U.S. aggregate was down 22 basis points on the week, with the government sector down 21. Not unexpectedly, the longer duration corporate bonds were down 28 basis points, investment grade corporate bonds. And then mortgage-backed securities were down about 18 basis points. High yield corporate bonds actually rallied about 30 basis points, and bank loans were up 18 basis points. So a bit of a mixed performance there in the fixed income markets, depending on the interest rate sensitivity of the securities in question. Looking at the commodity land is in the red for the week, with the BCOM down about 75 basis points. Precious metals are just continuing on their rally, up 51 basis points on the week, but industrial metals sold off, down 84 basis points. Drilling into some of those subcomponents, WTI crude's currently trading at $62.83 a barrel and up 11 bips on the week. So really nothing to do there. Copper was down about 0.5%, and gold, everybody's favorite pet rock, right now about $3,675 a troy ounce, up about 0.5% on the week. The dollar kind of interestingly rallied this week. I mean, it was one of those maybe sell the news situations there in the dollar. The dollar index is currently at 97.6, up a handful of basis points on the week. And that kind of rounds out the tail of the ticker tape. What do you think, Mr. Kimmel?
Yeah, it's kind of interesting week. Even though we saw, a few reversals across, fixed income and commodities and currencies, you did see like on the rate curve, you saw, the 2-year briefly drop, below 350. Kind of seems like there's support around that 350 level on the 2 year. And the 10 year, it's more of like a around 4%. We briefly broke through that just following the FOMC meeting release on Wednesday, but it kind of quickly popped up on a yield basis, currently running at 413. What's notable though is, interest rate implied volatility. We like to look at it as proxied by the move index, which looks at implied rate vol across the yield curve. That is moving lower. So even though we're getting these kind of larger moves across the yield curve, it does seem like expectations or the uncertainty around future yields is moving lower, with the move index at the lowest level since January 2022, right, before couple months before the Fed started hiking rates. We're seeing a lot of like correlation too, on the week when we saw yields, kind of pop through those kind of key support levels. Dollar sold off as well. I think Dixie made a multi-year low just on that 96 handle and kind of popped back, last day or two. And, that correlated with gold kind of breaching all-time highs for the week. So seeing a lot of cross asset correlations this week.
That those are some interesting points you bring up. I mean, all of that trading activity and price discovery around the Federal Reserve's meeting, I think, is expected. And we're definitely going to be having to watch those key levels, like the 4% on the 10-year that you mentioned, I think is a key level to watch as we bond geeks will keep our eyes peeled. But with that, maybe let's roll into the macro for the week. What do you think the top things that happened this week? I mean, it's pretty obvious from my point of view.
Yeah, I would say this probably the FOMC meeting. That might have been top of mind. That was the top. That was the top of the ticket this week, rightfully so. I think a lot of market participants were eagerly awaiting what would transpire at the FOMC meeting on Wednesday. And I'd say it probably was a little less interesting than a lot of people were expecting. We did get a 25 basis point cut to 4.25 corridor. There was a lot of talk about how many dissents there would be. Some strategists were talking about, you could see, upwards of 3 dissents, which we hadn't seen, I think, since the late 1980s. But we only got one dissent. One out of the 11 voting members voted for a 50 basis point cut as opposed to the 25 that was which the majority voted on. We all know who that was. That was the new voting member, Stephen Miran.
Powell said in his presser, his new colleague.
His new colleague, yep. And I thought what was interesting is how, Powell kind of framed the move as this like risk management decision, emphasizing the downside risks to employment, kind of, giving some credence to the rise in inflation, but it's clearly the key concern for the FOMC right now is kind of the downside risk to the labor market, just given the economic data that we've seen has definitely slowed. And he gave weight. He said it does look like there are some supply dynamics that could be weighing on labor and labor growth, just given the pullback in immigration. But he did say there is a demand element. You are seeing a decline in labor demand. So it just presents elevated risks for the labor market going forward, and hence why they're re-engaging their cutting cycle. I thought another kind of interesting development or dynamic as well with the FOMC this week was the statement of economic projections, just what was forecasted by the 19 FOMC members as far as like policy direction goes. A lot of dispersion there, which indicates just like, I take that as very low conviction on their forecasts. If you just look at like the 2025 dots for policy rates, you had Steve Miran, who was the outlier there. He expects or is voting for 5 more cuts this year. So he wanted 50 basis points this week, 50 basis point cut in October, and 50 basis points in December. And then you had on the high end, you had 7 of the 19 members thinking that you were kind of, one and done this year, when one member actually voted for no cuts at all, including this week. So what we did end up getting with the median is it just showed, a 3 cuts um, forecasted for this year, an additional cut in 2026, and an additional cut in 2027. Um, for this year, kind of in line that's in line with, what the market is projecting, but, market is projecting a few more cuts, next year. So quite a bit of, I think, dispersion and uncertainty as far as Fed policy goes for the medium term at least.
Yeah, I mean, I couldn't agree more. There's definitely a high degree of confusion there as to what's going on, especially some of that language regarding the risk management cut. And as you mentioned in the summary of economic projections, and we'll post these charts for our listeners later, but the dots are all over the place, as you mentioned. And then there's the obfuscating factor of you have non-voting members, inputting their information into those dots. So it just creates more kind of a smoke screen trying to discern what's really going on in there.
Yep. Really hard to get a clear read on, Fed expectations, at least over the medium term, just based on those dots.
Looking at the SEP projections, they expect the unemployment rate to rise to 4.5, in 2025 before dipping back down towards 4.4, 4.3, 4.2 in 26, 27, and 28. I find it kind of interesting that they're quite convinced that the inflation will be transitory based on the one-time tariff increases. They're projecting PCE to go up to 3% this year and then fall towards their target of 2% in 2028. 2.6% is their prediction for next year. So they're definitely, as you highlighted, Mr. Kimmel, focusing on managing downside risks to the labor market, and they're seemingly willing to tolerate higher inflation because they expect it to be, they don't expect it to be sticky.
That's right. That's right. It's their I think they view any uptick in inflation over the coming months to be, largely driven by these tariffs centered in the core goods sector. So, it largely kind of one-offs, and, those more persistent components of inflation, like, services and, the shelter component. I think they believe that those more sticky, persistent components that tend to be more linked to wages are going to head lower. And if you do have, a softening in labor market conditions, that in the end should pull those more demand-driven inflation components lower.
It's kind of an interesting backdrop we find ourselves in. What else did you find interesting this week?
Yeah, I mean, we got an update on the consumer, and their spending power this week. I think the key economic release this week was the retail sales for the month of August. We got that on Tuesday. It broadly came in much stronger than the economists were expecting. We saw a 0.6% rise in the headline number, beating the expectation of a 0.2% increase. And you look at the control group, that strips out a lot of the components and actually feeds into the GDP estimate. That was also very strong. That rose 0.7% month over month. Again, well above expectations. And the strength, if you look at the different components, was pretty broad based, including autos, food services, clothing, and electronics. So all in all, pretty strong read on the consumer, at least for the month of August. So it's kind of an interesting disconnect, right? Between, we are seeing this weakening or softening in the labor market, but it doesn't seem to be feeding through into, a pullback in consumption. And I've seen, one view on that makes some sense to me is that, consumption is being largely supported by like your higher income cohorts who are much less sensitive to labor market conditions. So you can see kind of a weakening in the labor market, but these higher income cohorts who tend to be, I guess, less cyclically sensitive or, continuing to spend.
Yeah, I think that's a good point, Ryan. You know, we have this situation where the 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 sensitivity to unemployment is clearly the job growth is slowing, right? And we haven't had unemployment rise too much. So as long as equity prices remain very elevated, those wealth effects will be driving consumption in the higher income cohorts.
Absolutely. So it's a interesting dynamic to follow. And it just raises the question like how much for how much longer can aggregate consumption stay supported if you do see a continued weakening in the labor market. Also on Tuesday, we got kind of like your final input on the inflation front. We got import prices came in a bit hotter than the market was expecting. It rose 30 basis points month over month, beating the consensus that was actually expecting a month over month decline. Um, Capital goods and consumer goods saw notable price increases. And when you look at the year over year number, that was actually flat, with fuel imports down 10%. So when you strip out the fuel, you got import prices up 0.9% year over year. And then, what analysts do is they get the inputs from CPI, PPI, and import prices, and they can pretty put together a model that projects, the PCE report for that respective month. So following the CPI, PPI, and import prices that we got over the last 2 weeks, economists now are projecting core PCE to rise a relatively benign, 20 basis points for the month of August. So I think that gave the Fed, more comfort in cutting this week, just given, they tend to focus more on core PCE. So, not really seeing in a reacceleration there as far as core PCE goes. But we will get those numbers next week. Also of interest was the, weekly initial jobless claims numbers. As you guys noted last week, we saw a pretty significant rise in initial jobless claims. But that completely reversed this week. We saw
Texas is claiming there was a bunch of fraudulent inputs there. It's kind of interesting.
Yeah, that's what I'm seeing as well. That's what I'm reading is that it was kind of the main driver of that spike. And you do tend to see some volatility around holidays. We had the previous reported period was for the week that included the Labor Day holiday. So, that spike that we did see in initial jobless claims, that was completely reversed. And if you look at the 4-week moving average, we're pretty much unchanged, week to week at 240,000. And that was all what also interesting is continuing claims dropped as well, and you saw some downward revisions. So continuing claims is 1.92 million, which marked a 4-month low. So you're not really seeing this material increase in, the number of layoffs. So while, it is concerning that you're not seeing, labor market growth or maybe near zero labor market growth, it's just not leading to a significant layoff cycle. So that's on the plus side. And then just to round out the week, we got industrial production that came in a bit higher than expected, 0.1% month over month. On the manufacturing side, I think that's what folks pay more attention to. That increased 0.2% month over month, but that was largely driven by a 2.6% surge in autos. So when you kind of take a step back, it was a little bit underwhelming, especially when you include the downward revisions that we saw to the previous month. And we also got some housing data, the housing starts and building permits, both came in weaker than expected. So, you're clearly seeing this, trend lower in permits, and it's indicating just the softness that we're seeing in the housing sector. So that wraps it up for on the economic front for the week, Eric.
That's a very comprehensive overview. And I would note on the housing front, we know and we've discussed before that the housing sector is it's highly sensitive to interest rates because of the cost of home ownership. And it'll be interesting to see if the rate cutting one rate cut isn't going to save the housing market, but it will be interesting to watch if future rate cuts materialize as predicted in the summary of economic projections, how that will impact the housing market. You think it might be accretive, but we'll just have to wait and see. Housing affordability is quite unaffordable right now. Looking at the predicted rate cuts implied in the market right now, imputed by futures prices, and we're seeing a cut coming at the October 29th meeting, cut coming at the December 10th meeting. So two more cuts priced in for the year, absent any big shifts in the labor market. And then for next year, there's kind of a debate. It's up in the air if there's going to be a cut at the first meeting of 2026. Currently, the probability is right around 50%. So that's kind of where the market sits. And remember, we'll get more forecasts at the December meeting, so that will kind of rejigger the market's expectations going forward. Kind of looking ahead to next week, I wouldn't call it like uh, what would you call it? A tier one week, Kimmel, in terms of data coming out?
I'd call it a tier 1.5. It's kind of it's I think PCE inflation that'll be kind of the most important release. We get that on Friday, and as I mentioned, the economists are expecting a bit more of a benign month over month reading, 0.2%, which would keep the year over year rate unchanged at 2.9. Um, on top of that, I'd say, weekly jobless claims, got to continue to watch that to see if there is any material uptick in layoffs. We're just not seeing that yet. And also on Friday we get the personal spending and income data. So it does look like we should get a pretty strong read through on the spending front, just given where retail sales came in this week. I think that's really what the market is going to be focusing on.
Yeah, pretty light week, but some important hitters on Friday. So, Tuesday we do get the S&P Global U.S. Manufacturing PMI, but that's pretty wonky stuff. I agree with you. The most important things to watch are the jobless claims and the PCE numbers that come out in the latter half of the week. But that kind of wraps it up for the week.
Yes, thank you to our listeners out there today on Deal Minutes. Hit us up on X at DLine Minutes, or send us an email at minutes@doubleline.com with any questions, comments, or suggestions.
You can find more information about DoubleLine at our website, doubleline.com. Don't forget to subscribe to our YouTube channel at youtube.com/doublelinecapital. Thanks for tuning in. I hope everyone has a great weekend, and make sure to check out Jeffrey Gunlock's CNBC interview if you haven't had a chance yet. He was filmed live from our offices in downtown LA post the Fed meeting this week.
Thanks, everyone. Take care. Have a great weekend.